Today I'm going to answer the number one question I get asked the most, and probably the number one question every CPA is asked the most, and that is, how can I save money on taxes? Now, unfortunately, I usually get this question when people are giving me their information to prepare their tax return. They'll come to me and say, hey, I made a lot of money last year, see what you can do. How can I save money on taxes? And I'll have to say, well, it's a little too late for that. We've pretty much just got to put the numbers on. Sometimes there's some things that we can do, and when we can, we certainly apply those. But the truth is that most tax strategies are implemented during the year, and the earlier you implement them, the better off you will be. Now, during this last tax season, I had somebody come to me that had switched their investments over from, say, dividends over to interest, and unfortunately the tax result of that was really bad. Before we get into that, I want to introduce myself. My name is Merrill Taylor. I'm a CPA. I've been preparing taxes and doing tax strategies for over 20 years with clients. We've helped people save millions of dollars in taxes using some of the things that we're going to talk about here today. So this client that came that had switched everything from, say, in stock investments, they had switched everything over to just bank account, just to holding it in a bank account and earning interest income. Now, the effect of that on their taxes was to basically double the amount of tax that they paid. The reason for that is that interest income is probably the worst income that you can have. It's worse than W-2 income, it's worse than all sorts of income. The reason for that is that number one, you earn a really low interest rate typically on interest. Like if you have that sitting in a bank, it's earning some of the lowest interest that you can earn. If you put that into a high yield savings, it's still earning a fairly low interest rate. You're never going to make a ton of money sticking a bunch of money into a bank account and earning interest income. The other reason why interest income is just terrible is the way that it is taxed. Interest income is taxed as ordinary income, which means it can be taxed at current rates all the way up to 37%. Then there is what's called the net investment income tax. If that applies to you, it adds another 3.8% on top of that 37, which basically makes interest income taxable at a maximum rate of 41% plus state taxes. If you live in California and New York and you're making a lot of money in those states, your interest income will be taxed at over 50%. So if you stick, say, $100,000 into the bank, and that's making 4% interest, you're going to be paid $4,000 in interest during that year. So very little interest basically coming in based on $100,000. And then over half of that, over $2,000 of that's just going to go out to taxes. That is incredibly inefficient, and in my opinion, a terrible, terrible thing to put money into. So we want to avoid interest income as much as possible. So what are the alternatives? What else can we do rather than putting a bunch of money into the bank? Now, that is the safest thing to do, right? Your money's just going to earn a little bit of interest, but it's going to go out in taxes, and so it's not going to grow that much when you factor in the taxes, but it will be safe. It's not going to go anywhere. These other investments that we'll talk about may have a little more risk to them, but they'll also have more reward, and in many cases will have a better tax result. So rather than putting a bunch of money in just a bank account and earning interest, you could put a bunch of money into the stock market, which would then earn dividend income. If that dividend income is qualified dividend income, that's better than interest income, because qualified dividend income is taxed at long-term capital gains rates, which makes the maximum tax on those 20%. They can be taxed at as low as 15 or even as low as 0% depending on your tax bracket. If you're in a really low tax bracket, you may be taxed at 0% on that qualified dividend income. There is the net investment income tax that applies to those. So if you are being taxed at 20% plus the net investment income tax, that could be a potential maximum tax rate of about 24%, which is far better than the 41% for interest income. You still have state tax on that as well to factor into. But even if you're in California, New York, some of those higher tax states, you're still going to be somewhere around like the mid-30s on your tax brackets on there. You're not going to be over 50%. So that makes that investment a lot better, and that's just based on how you invest things. Now, of course, the stock market goes up and down. We've seen that recently, and so that can be a little bit of a difficult ride when you see your money dropping because the stock market drops. But there's other things that you can put money into. So let's move on to another one. Another one that you can do, that we talked about, interest income, getting hit with both federal tax and state tax. So if you live in a state, let's say it's like California, New York, or a high tax state, and you still want to put your money into a safe investment that's earning interest income, well, you could look at the US Treasury, the T-bills. Those are taxed federally the same, so you could still pay up to 41% federally, but there is no state tax on those. So you could escape the state tax completely on doing those. Another really, really powerful investment that you can make is what's called municipal bonds. They're also called muni bonds. Muni bonds are not taxable for federal taxes, so you'll pay zero tax. And if you invest in muni bonds in your state, the state usually doesn't tax those either. So we have a lot of clients that will invest in municipal bonds, and they will not pay any federal tax, and because they invest in municipal bonds from their state, they don't pay any state tax either. So it's income that completely escapes taxes. Now, your rate of return on those are going to be a little less because the municipalities recognize that you are not paying any tax on that, so you're willing to accept a lower amount of interest or lower amount of return on those. So the return may not be as good. And again, I should say I'm not giving investment advice or anything. Talk with your investment advisors. I'm just kind of going through tax ideas here. This is not really like tax advice either. You want to talk to your tax advisor for that. But we're just kind of going through and explaining the different tax effects of different investments and how setting up your investments can help you save money on tax. So that's municipal bonds. Those are good. Now, when it comes to stocks, we should go back and talk about dividend income. When you put money in stocks, and stocks pay you a dividend, if it's qualified dividend, you're at long-term capital gains rates. Now, when you go and you sell those stocks, if they've appreciated in value, you're going to recognize capital gain. If you've held that stock for less than a year, then you're going to pay short-term capital gain rates, which are just your ordinary tax. So those puts us back there again at a potential of 37% federal plus the net investment income tax. So we're back to 41% of tax on those, plus whatever the state tax would be on it again. So, high tax states, you could easily be paying over 50%. That's on a short term. So if you sell it after holding it a year or less. If you hold it for longer than a year, they become long-term capital gains. And now we're back to that qualified dividend tax treatment where they're taxed at a maximum of 20% plus about that 4% of net investment income tax, so about 24%. Plus state tax on top of that as well. So that's the real benefit of stocks, is that you put the money in. You don't get a deduction when you buy stocks. A lot of people think that I invested money in a company that should give me a deduction. It's not. It's just an investment in there. When you sell that stock, your investment comes back as non-taxable. So let's say you put $100,000 into a stock. It appreciates to $150,000. If you sell that stock at $150,000, you're not taxed on the $150,000. You're taxed on the difference between the $100,000 you put in and the $50,000 it grew at. So you're only taxed on $50,000 of that stock. And if you've held that for longer than a year, that's long-term capital gains, 20% maximum plus the 3.8% net investment income tax. Now, so those are investments that you put money in and you earn some money coming back. You don't get a deduction when it goes in, and then the money that comes back is taxed at various rates in various ways. Now, what if you could put money into an investment and actually get a deduction on the way in that would help you save money on taxes? There are two things that I know of, and probably more than that, but two things that we'll talk about that are kind of the main ways that people get a deduction for money going into something. The first one is an oil and gas investment. So when you have a working interest in oil and gas, the money that you put in, you can get a deduction back on that, usually between 80 to 90% of the money you put in. So if you put $100,000 in, we'll take an average of that. Let's say it's 85% that you get back. You'll get an $85,000 deduction, which will then save you tax based on your tax rate. And then when that oil and gas investment, when those wells start to produce and the money comes back to you, that money is taxed at ordinary tax rates. However, there's also what's called a depletion deduction that comes back with it. And that depletion deduction allows you to be taxed on less than the money that is coming back to you as well. So oil and gas investments are a great way to save money on an investment going in and then to save money on the investment as it pays out to you. So you got two tax savings that come with that one. Another huge one that will actually put more money in your pocket than you expense out. So with like oil and gas, you have to put $100,000 in. Let's say you get an $85,000 deduction. Then let's say that saves you anywhere from $20,000 to $30,000 in tax. So you're still out $100,000, save $20,000 to $30,000. You're still out of pocket. Say $70,000 to $80,000 or $60,000 to $80,000 on that investment. Now, this last one that we'll go through is one that you can actually get more of a tax benefit than you put money in. And we'll walk through that and we'll have a longer video that goes through this strategy in more detail, but this is called the short-term rental strategy. Short-term rental, oil and gas, I should say, applies to any type of income. It can apply to W-2 income, investment income, business income, any type. Short-term rental strategy, the same type of thing. It'll apply to W-2 income, investment income. We had a lot of clients do short-term rental strategy during this last tax season. They saved anywhere from $20,000 to $100,000 plus in taxes from doing it. And those clients were in all sorts of things. Some of them had just W-2 income. Some of them had business income. Some of them were retired and just had investment income. It worked for all of them in all those situations. And the way that the short-term strategy works is that short-term rental means that it's on average you're renting that property 7 days or less during the year. So think about like an Airbnb property. So you buy an Airbnb property, you rent it on average 7 days or less during the year, meaning each rental. So let's say you rented it 5 times and each time it was rented, people rented it anywhere from like 3 to 5 days, right? So that would be an average of under 7 days being rented. Then as long as you actively participate in that, and again, we'll go through all of those rules in a different video and get into more details, so make sure to subscribe to get that video. As long as you actively participate in it, and meet those rules, then the loss that comes off of that is deductible and will offset those other sorts of income. So what happens is, if we break this down practically, let's say that you buy a short-term rental for, it's worth $500,000. So you buy it for $500,000. You're not putting $500,000 into that. When you buy a rental property, when you buy real estate, you generally have to come up with a certain amount to put down. I think with like short-term rentals, it would be like 10% that you'd put down. So $500,000, you'd put down $50,000 would go into that. You'd get a loan for the other $450,000. Now, what is powerful with real estate is that there's what's called a cost segregation study. And I have another video on that goes through details of that. But basically, a cost segregation study says, okay, yes, I own a building and short-term rentals are depreciated at 39 years. So if you bought a $500,000 property, you'd have to separate out part land, part building. The part land cannot be depreciated. The part that goes to the building can be depreciated, but it's depreciated over 39 years, which means that there's a long time for you to realize the deductions that come from that. However, a cost segregation study would come in and say, okay, yes, there's a building here, it's depreciated over 39 years, but there's components inside that building that should be depreciated much faster than 39 years. There's flooring and fixtures and other sorts of things in that building that can be depreciated much faster. And you can take like bonus depreciation on those, and so you get this much faster write-off of those components. And it varies, it depends on the property, but you can say anywhere from say 10% to maybe 30% or more of that property can be written off through bonus. So, let's say that you buy a property for $500,000 and 30% of that property can be written off through cost segregation. So that would mean a $150,000 deduction. You only put $50,000 in, So you put $50,000 in, and now you're getting a $150,000 deduction for only putting $50,000 in. And you're able to do that because the loan that you have on that gives you basis and allows you to take a loss based on the loan that you have, because you have to pay this loan back. As long as it's a recourse loan, a loan that you have to pay back, you can get basis for that. So you put $50,000 in, you get a $150,000 deduction. Well, guess what? Now that starts to save you more in tax than you actually put in. You're going to save more than $50,000 in taxes. You only put 50 in, you're saving more than 50, so you end up ahead. So that's the short-term rental strategy. So we started this video talking about the worst type of income, right? Interest. So you put a little bit of money in the bank, you put, say, $100,000 or whatever it is in the bank. You earn $4,000 in interest, and half of it goes out in taxes. Worst investment, just a terrible strategy. We compare that with a short-term strategy where you can put half the money in, you can put $50,000 in, you get this big deduction that saves you, more than $50,000 in taxes, and then you have an ongoing investment. You have a piece of real estate that you now own that's generating cash flow because you're renting it out, and you can sell that at any point and make money for it. And as long as the home market, the real estate market stays strong and keeps going up, then you can sell that at a gain. You can also do a 1031 exchange, which means you can exchange that for another, which you can't do. Let's say you bought stocks and you looked at the stock and say, these aren't performing really well. I want to trade these for different stocks. Well, their 1031 exchanges don't apply to stocks. You have to sell it and recognize the gain or loss and then buy the new stock. With real estate, you could buy a piece of property and say, oh, hey, this one's not performing really well, or I want to get a bigger one, or a number of reasons that you want to move on from that property. Well, you can exchange that property into a new property as long as you're exchanging it into one that's more expensive or a bigger or costs more, that has a higher fair market value than the property you're selling. You can defer all the gain from that, and you can keep doing that throughout your life. So that's a really powerful strategy. So we started off again with a really terrible way of earning income and the higher tax you pay, all the way down to being able to save money on taxes. So that's the reason why your money, where you put your money makes a difference. And by the time that you come to get your tax returns prepared, we basically have to look and say, okay, where did you have your money? What did it earn last year? Okay, that's what it is. But if you're early enough in the year, you can say, hey, I want to move some of my savings over to a short-term rental. Well, yeah, now we can start to really look at that and save money on taxes that way. If you'd like some more updates on this, make sure to subscribe. We'll keep doing updates. And if you'd like to get our weekly newsletter that has our updates as well, go to taxtutor.com.